So this house right here cost $350,000, but I paid just $7,000 to get it. Now let me show you how I did it without utilizing traditional financing, no banks, no credits, or any of my credentials. So most people think that you need 20% down payment, traditional financing requirements like bank statements, tax returns, and things of that nature to buy a house. And even though all of that is true, there is a better and more efficient way, especially in this market. It is called credit financing. Now, this property that I'm in, I bought it with only a 4% interest rate, even though the market rate's at 7%, by utilizing a strategy called subject to. And in simple terms, what that means is I basically took over the payments on the existing mortgage. The existing mortgage stayed in place in the seller's name, and I just took over payments in perpetuity until the loan is paid off. Now, the benefit of doing that is I didn't have to go through any banks. I didn't have to, anybody pull my paperwork, my credit or credentials. I just paid the seller cash and paid them their equity portion and took over the payments starting next month at 4% interest rate. So this house is worth $350,000. The seller's current mortgage is $280,000. Now, they needed to sell quickly because the husband got a job transfer and they're moving to Montana. Now, traditionally, when you sell a house, you have selling costs. That includes 3% buyer's agents commissions, 3% seller agent commissions. That's 6% combined. You also have closing costs, which typically is like 2%, and in a market like this, oftentimes you have to give what is called buyer concession. So typically that runs around 10%. Now, they didn't have the time, and quite frankly, because they've only lived in the property for a couple years, they haven't built enough equity to cover that payment. So they said, hey, I'm okay with you coming in, taking over the payments on the existing mortgage and just pay us a couple $1,000 just so that we can, be on our way to our next adventure. So I wind up paying them $7,000. The mortgage balance is $280,000. I paid them $7,000. So my all-in cost is at $287,000, and I was able to capture about $50,000 plus of built-in equity just by buying this property. So you may be wondering, how are you going to make money on this transaction after you've bought it? Now, there are a couple different options I have. The first one, obviously, is traditional long-term rental. Now, the mortgage on this is about $2,350 every month. That includes the principal, interest, taxes, and insurance. So that's the total payment on the property. I could go out and rent it out on a long-term rental for a year, 2-year lease for $2,500 to $2,700 every single month. So that option, after all expenses are paid, would net about $200 every month. Now, that's not a huge number that I'm excited about, even though that's not bad in the sense that because I purchased it with a subject to, and my underlying mortgage or interest rate is only 4%, about $500 of that monthly payment actually goes towards paying down the principal. And that's a sizable amount. Every year, that's $6,000. Now, even just that, if I wasn't to make any money on the cash flow, and just that's $6,000, I paid $7,000 to get this property. That's almost 100% return right there. Now, that's the first option I have with traditional rental. The second option is to go short-term rental. And a lot of times with short-term rental, you could triple your cash flow by OTAs like Airbnb, VRBO, Booking.com, and the like. So I would have to furnish this property. It's a 4-bedroom, 2.5-bath property, 25 minutes from downtown. It's a good product to market on a short-term rental basis. So on a short-term rental, I could probably net $1,000 every single month or $2,000 every single month just by renting it on Airbnb. The third play is similar to the second play, but it's a different type of rental. It's called mid-term rental. I could rent out to, people who are looking for longer term rentals, but still short, like 3 months, 6 months time frame. So like you're talking insurance companies where, homeowners maybe had damage to their property, they're local here, and they just need somewhere to stay while repairs are being done to their house. Now, they would come rent it out for, 2 months at a time, 3 months at a time, anywhere from $5,000 to $6,000 every single month. In that option, because the underlying mortgage again is $2,350, I will be netting over $3,000 every single month after all expenses are done. So that's another great option. On top of the fact that I'm also getting the benefits of the mortgage paid out in all 3 options. The fourth option I had on this property is to do what is called a wraparound. Traditionally, if you don't know this, 60% of people who apply for mortgages get denied. And so think about that, 60%. That's a huge number. People who go and put in applications, loan applications to buy a house, they get denied. And the truth is, if they didn't think that they were going to get approved, they wouldn't apply. So that number, the pool of non-qualified buyers is much larger than the pool of traditional buyers. And so what a wrap does is I can take this property and go to non-approved buyers that have capital, maybe have $40,000 down payment, $50,000 down payment, and say, you know what, I will be your bank. I will finance you the property at X amount of term, and they would pay premium on the interest rate. I would finance to them at 3 points over the prime interest rate. And right now, prime interest rate is at 7%. So I probably finance to them at like 10%. And so every month I would cash flow over $1,200 in monthly profits. And with a wrap, the benefit of a wrap is I've sold the property to them. I'm not the owner anymore. I just sit back and collect a check every month, just like the banks do. Because guess what? In this scenario, I am the bank. I am financing them the payment. In that option, I would get a huge lump sum payment up front, the $40,000. I'll get $1,000 payments every single month for perpetuity for the next 28 years or 27 years. So after evaluating all 4 exit options, I decided to go with the short and mid-term rental play. Now, the long-term rental play was great, but it doesn't provide me with enough cash flow every single month to justify going that route. The wrap, although it gives me a huge lump sum up front, $30,000 to $40,000 plus $1,000 net in perpetuity for the next 20 plus years, which is great. I lose all my tax benefits because I sold the property on a wrap, right? So I don't get any depreciation or anything like that. With the short and mid-term rental play, not only do I keep all the cash flow, I quadruple the cash flow. I can make anywhere from $1,000 to $2,000 every single month. I also get all the tax benefits of home ownership. And specifically with short-term rentals, there are tax incentives that I can leverage. I'm not a CPA, so check with your CPA. There are tax incentives I can leverage to really offset my income. And lastly, the other reason why I decided to go with this play is because we're less than a year from the World Cup. And if you know what happens at the World Cup, tons of people come into the city. Houston is one of the hosting cities. They're going to host about 8 matches. So it's going to be a lot of traffic and a lot of demand. And this is a very, very unique property. So it's a 4-bedroom that I'm going to be making into a 5-bedroom. And so it could host up to 14 people at the time. So during the World Cup, I could charge as much as, I don't know, $3,000 to $5,000 a single night. And in just the span of 3 weeks, who knows, I could net $20,000+ on just this one property. So that's the added bonus that allowed me to justify going down this route. But the main thing is extra cash flow, tax benefits, and the fact that I keep this in my portfolio as a legacy property for the next 20 years. So with that being said, guys, we're going to be furnishing this property in the next 2 to 3 weeks. At least that's the goal, with design, new furniture, and staging. And then listing on the OTAs like Airbnb, VRBO, Booking.com, and the like. If you enjoyed this video, please like, share, and subscribe, and I'll see you in the next video.